Welcome back to FX Street. It's 8 a.m. Eastern. Today's, Wednesday the 29th? 2012. Welcome back, one and all. Great that you could join us. At 8:30 a.m. Eastern, 30 minutes from now, we have U.S. GDP numbers that will be released. The expectation is 2.8%. It's a big number. Remember, the last GDP number came in at 1.8%, and that was the higher end of the range of the Fed's projections. So we'd like to see if the GDP numbers can continue to confirm our suspicions that maybe the GDP number is reflecting a stronger economy. I happen to think that's not the case, but you can't necessarily argue with the numbers. At any rate, that's 8:30 a.m. Eastern. I want to talk a little bit about the news that was released just a short time ago in the Eurozone. I think this is probably one of the biggest news stories, one of the most interesting news stories in the Forex market in a long, long time. This is on Bloomberg.com. Here's the link for everyone, and it kind of ties right into what we're talking about in the U.S. It's the same theme. It's the same theme, and for those of you that joined yesterday, we had a central bank webinar. We talked about the central banks and central bank statements and basically the different attitudes coming from a different economic attitude that determines how a country is going to try to fix their economy. And I won't get into the whole, Adam Smith, John Maynard Keynes, economic argument, but I probably went a little bit overboard yesterday with that. But nevertheless, it does make a difference. Now, this is pretty incredible. What happened earlier today? European Central Bank said it will lend money in the form of bonds to 800 different financial institutions all over the Eurozone, 800 different banks, for a total of 529.5 billion euros. Okay, the 3-year loans that will be issued. I have to look at the article a little bit more closely, but from what I understand, they're going to issue these loans at very, very low interest rates, basically 1%. The requirements for collateral are not very stringent, so it'll be very easy to get these loans. These are loaned by the ECB to the banks, about 800 different banks. In the last, the first 3-year operation, and this is not the first time the Eurozone or the European Central Bank has done this, they lent to 523 banks. This time it's 800 banks. So the big number is how many banks are going to be able to take advantage of this program. And the program will allow these banks to borrow money again at very, very low interest rates, around the average of the ECB's benchmark interest rate, which is 1%. Now, the idea is that the banks will be able to to borrow money at very, very low rates, and that money will turn around and find its way back into the economy. And something that we talked about yesterday during our webinar was the fact that if you look at this recession or this, economy, whatever you want to call it, whether it's a recession or a depression or just a downturn, over the past couple of years, from 2008 until now, the entire story is the banks. The reason that we got into this mess, part of the reason was because, the housing market became very much overextended through the banks. And then the banks, Lehman Brothers and a lot of other banks went under, hundreds of banks went under, again, through the banks. And now what we're looking for recovery. We're looking for signs of recovery. In the U.S., what's the big problem with the housing market? It's not that unemployment is still at 10%. We're at 8.3% now. The problem is those of us that have jobs that want to buy a house, it's very, very difficult to get credit, again, from the banks. The banks is the center of this entire economy over the past 4 or 5 years. Now that 800 different banks, small banks and large banks all over the Eurozone will be able to take advantage of this program and to borrow money at very, very cheap rates. The question is, the theory is the money will find its way back into the economy. The question is where. Now, if I'm a big bank, now there's ideally, let's back up. Ideally, what the banks will do is borrow this money, turn around and open up their credit lines, open up a fire hose full of credit. So anyone out there that wants to invest in the business or to buy a house or to get credit to put money into the economy to try to start something new, ideally that's what's going to happen. Maybe the banks will lend to private individuals. Maybe the banks will invest in businesses in their local neighborhoods. Maybe the banks will do what they did in the U.S., which is just very simply double down on their own investments, meaning the banks have huge losses in their portfolios, huge losses in their real estate investments. What if the banks borrow this money? See, there's not really any kind of stipulation. From what I understand, the banks don't have to do one thing or the other. They basically can do whatever they want with the money, which is the same criticism that I have for the number one first stimulus program we had in the U.S., the TARP, the Troubled Asset Relief Program. That money was lent to the banks, but then what did the banks do? They held the money in their savings. And they basically did that to shore up their own investments, and they paid their own CEOs and executives big bonuses, and they suffered a lot of criticism. What will the banks do now with the money? That's the big question. Now, in terms of the foreign exchange market, this presents a really interesting idea because, and it's not my idea. It's actually listening to Bloomberg just a little while ago, and they mentioned something about this, that the euro currency very well may become a funding currency. And I know we're talking about GDP, but we have a little bit of time. We have 23 minutes to go. And we're going to get back to the GDP as well. This all ties in together. But let's take a step back. The number one reason why currencies move is the expectation of higher, lower interest rates. Now, if the stock market is strong and people are optimistic and there's a general sense of comfort in the worldwide market, we're going to buy higher yielding, higher risk assets, higher yielding currencies like the Aussie and the Kiwi, maybe commodities, making a bet that the economy will improve and consume more commodities, or high tech stocks or high yield, low investment grade, bonds, etc. Well, that means that we would buy the Aussie or the Kiwi or maybe the CAD. And we'd also buy a currency that we think that the economy is very bad now, but it has room to improve. Now, over the past couple of years, when we talk about that, we talk about Aussie against the yen, Aussie against the dollar, Kiwi yen, Kiwi dollar, because Aussie and Kiwi are higher yielding currencies, the dollar and the yen are lower yielding currencies, and we'd also buy the euro yen and the pound yen, because although interest rates in the UK and the Eurozone are very low right now, we would expect that they would start to raise the rates as economies improve. Here's the problem. The ECB, by issuing this 5 billion euro, tranche of bonds, I think it's the third round, biggest so far, at least in terms of the participation. Now the European Central Bank is basically locking in 1% rates for a longer period of time. Imagine this. We're running a bank. We're running a small, we're the ECB. Let's make it easy. You and I, all of us together, we've been put in charge of the ECB. And countries and other companies and whoever it is out there is borrowing money from the European Central Bank and paying us 1%. And then sometimes the ECB will borrow money from other banks and they'll pay out whatever the interest rate is in the other central bank. But now by issuing this enormous bond issue at 1%, it's basically like doing the next 2 or 3 years of lending all in one day. So it's basically locking the European Central Bank into only being able to collect 1% for a huge issue, a huge loan. This puts the European Central Bank, us, that are running the ECB, at a little bit of risk. Because we know we cannot make more than 1% on any single bond that we're issuing right now for the next 3 years. This is huge. What will banks do? Maybe they'll take it and they'll take the 1% loan. I mean, if somebody gave me a guaranteed 1% loan, what's the easiest, safest thing to do? Find another currency out there with higher yield and throw that money into that higher yield. Now, not $1 million, not 10 million. We're talking about $5.25 billion. Is it billion or is it trillion? It's got to be billion. Yeah. 529.5 billion euros. So, my contention is that in the forex market, you may see the euro start to behave like the yen. Maybe not the yen, because the yen has very low rates, it's 0.1%. But I don't think that we're going to see the European Central Bank raise rates anytime soon. I didn't think that was going to be the case beforehand, but this really locks in the ECB to low rates for a long time. And even if they raise rates, they still have all of these outstanding bonds. So now I think you may see these carry trades against the euro really start to develop a new trend, a new leg to the trend. Shorting the euro against the Kiwi, for example. Shorting the euro against, here's the euro Kiwi, here's the euro Aussie. Again, we had a consolidation pattern, a nice bump up, but since then, we've turned back to the downside. Fibonacci actually does make quite a bit of sense over here at the 23.6. We could say euro against CAD as well. I have a chart somewhere here. Here's euro CAD. Not that the Bank of Canada has any higher interest rates than the Eurozone, but who is now more likely to raise interest rates, the Eurozone or the Bank of Canada? Well, I would say neither, but the Bank of Canada is much more likely to, because the European Central Bank is not likely to at all. Well, this makes sense in terms of the carry trade, but think about Europe in terms of the internal economy. Germany, France, Italy, Spain. Keep borrowing costs down. That's good. That's good for these countries that have really been struggling. Greece, Portugal, Ireland, Spain, Italy. These countries that are sort of like on the fence, I think this is really good. But remember, Germany is an export-driven economy, like Japan, like Switzerland. The lower the currency, the better for them. Germany exports BMWs, Mercedes, and a lot of other, really great things all around the world. So the lower the euro is, the better for Germany. Well, we see the euro CAD. If we expect this to go down, which I do, or the euro Aussie, or the euro Kiwi, or the euro against almost everything, if I expect the euro to go down, well, that means that Germany will sell more BMWs, or BMW will sell more automobiles, Mercedes, and et cetera. So that's really good for the German exporters. But now, we have this false sort of glass ceiling that rests above the euro. That because we know that there's so many bonds that are being issued at 1%, even if the ECB raises rates tomorrow, which they're not going to, we still have this enormous bond issue out there that's telling us, hey, raise rates all you want, it doesn't matter. You've already committed to sell X amount of bonds, 500 and something billion euros worth of bonds at 1%. It doesn't matter if you raise rates or not. So a low euro, to summarize, is good for Germany, like you said. It's when you look at the economy, when you talk about economies that sit on extremes, like Japan and Switzerland and Germany, those are export-driven economies. In terms of Italy, Spain, Portugal, I'm familiar with their economies to an extent. If anybody in this room right now is from Italy, Spain, or Portugal, if you happen to know, there are exports that are involved, but how much of Spain's economy is exports and how much is not necessarily imports, but capital investment. You see, the opposite of an export-driven economy is the U.S. This is a capital-intensive type of economy. We benefit not that the dollar is strong, but a strong dollar is a sign that our economy is doing well. Because when our economy is doing well, foreign investment wants to come into this economy to buy real estate in Las Vegas and Miami, to buy Google and Facebook stock. Facebook one day will have their own stock. All that capital has to be converted into U.S. dollars. To buy U.S. bonds because it's the safest on the planet. To buy, invest in U.S. companies. So a strong dollar is the result of a strong economy in the U.S. A weak yen is what we want to see to anticipate a strong economy in Japan. A weak yen will create a strong economy in Japan because the weak yen makes their exports more attractive. Same in Germany. But Italy, Spain, and Portugal, how much is exports? How much for every euro that Italy gains in tourism and imports, or I should say they're exporting to tourism, they're exporting whatever else they export, how much of that is offset by the amount of capital that Italy benefits from, because Americans are coming to Italy to buy real estate there, and investors from other parts of Europe and Australia and around the world are coming into Italy to invest in Italian businesses. We're talking about trade balance numbers. This is something economists really have their hands full. If you really want to answer this question the right way, we have to look at each individual economy that uses the euro, the 17 different countries, England, Spain, France, Portugal, etc., and see what's their trade balance. Do they gain more? Does Italy and Spain and Portugal gain more from exports, exporting tourism, exporting food and services and products and things of that nature, or do they gain more from capital investment? Foreign capital, listen, Spain is a very large producer of solar panels. And that may be that if that industry really, takes on, a life of its own, maybe that'll offset that Spain will become more of an export-driven economy. I don't know the answer to that. It's a really good question. I know in terms of Germany, they're an export-driven economy. Now, and by the way, we have GDP numbers coming up. I have not forgotten. It's just that this is kind of a really interesting, direction to go here. I won't get, too obsessed with this stuff. But the question is, okay, we know the euro is not going to go above 1% for a long time. And all these bonds it's 1% plus, not more than 1%, 1% for a longer period of time. We're really the ECB is marking a line in the sand by doing this. This is a really big deal this morning. Now, that means for Germany, BMW is going to sell more cars and Mercedes, BMW, etc. Now, that means they're going to benefit more. That means inflation is going to start to go up. Now, remember the old president from the ECB, Trichet? He was very much concerned about inflation, especially in Germany. And if BMW and Mercedes, I'm just using those two companies as an example because that's what I can think of off the top of my head. But if those two companies end up exporting a ton of cars and doing very, very well, BMW makes more money, the employees make more money, the towns and neighborhoods around those factories make more money. The next thing you know, you see inflation. European Central Bank used to be very, very worried about inflation, and they used to have something to do about it. They used to be able to raise interest rates. Well, if inflation really gets out of control in Germany, they still can, but I would argue they're a lot less likely to. There's a much greater risk for inflation in the Eurozone now because the ECB has said, listen, we're in trouble. We're giving anybody who wants 800 different banks 529 billion euros in 1% loans for the next 3 years. Don't worry about the collateral. You don't need it. I mean, being a little facetious, but it's going to be very, very easy to get these loans. We want as many people to participate as possible. This runs a risk of creating real inflationary pressures in the Eurozone, especially in the export-driven economies that benefit from a low euro, like Germany. And, look, it's one of these days when I have the time, I want to prepare an entire study that looks at the different countries in the Eurozone. Which country is more capital investment or export driven? Is Spain more like Japan, or is it more like the U.S. in terms of the type of economy? Exports versus capital investment, basically imports. Question is, if I missed your question, by the way, please tell me. U.S., like other countries, to buy their super bubble equity, then drop down and kill others. Yeah, look, it's a market cycle. I mean, this is what happens. You have capital that moves from one economy to another, and sometimes bubbles are created. I have a theory that bubbles are created mostly because of government intervention, and the governments that pick winners and losers. When a government goes out there and says, you know what, I like the automakers, or I don't like the banks, or I do like the manufacturers, or I don't like green energy companies, and we're going to pass tax policy, pass monetary and fiscal policy that's going to directly impact those industries. That's when you start to see bubbles being created. The housing market in the beginning, in the U.S., and it was not created just because the banks had record low interest rates. It's because of some free housing act that was created a long time ago, many presidents ago, that that basically said, okay, anybody that wants to buy a house has a right to do so. And, if you want an FHA loan, put 3.5% down payment. If you don't have a good credit score, don't worry. If you don't have a job, don't worry. The banks, under normal conditions, would never have lent these loans, but the government says, don't worry. We guarantee your loans will be okay. Well, I would argue, Greenspan, look, he kept rates. If you believe that Greenspan is the reason, it's a very popular theory. I happen to disagree with it. But if we think that Greenspan was a reason why we had a housing market bubble, and that was a major contributing reason, Alan Greenspan reduced interest rates in the U.S. to 1% for a little bit more than a year, about 14 months, if I'm not mistaken. We have had low interest rates, 0% interest rates, almost 100 basis points lower. The lowest you can go in interest rates in the U.S. for, 3 years, 4 years. If the Fed does not raise interest rates until they're expected to, which is maybe 2014, we'll have 0 interest rates for 5 years. If Greenspan keeping rates at 1% for 14 months created the last housing bubble, how much will 5 years of 0% interest rates create? How much of a housing bubble will 5 years at 0% interest rates create? So a housing bubble, I would argue, would be 5-6 times as big as the last housing bubble. So I don't think that Greenspan is the reason why we had a housing bubble. We had a housing bubble because too many people that should not have been able to buy houses bought houses. You could say, well, the banks had loose lending standards. And then you could say, well, you could defend the banks and say, well, the banks had a guarantee from the government. And after all, if somebody guarantees me every single loan that I issue, I'm going to loan out to everybody I know. And I'm sure you would do the same. Somebody tells you, hey, loan money to whoever you want to loan. If you lose money in that loan, if they don't pay you back, don't worry, I'll pay you back. Show me one person that would not make those loans. It's great business. That's the situation the banks are put in, we're given. So everything starts from the top down. Question is, the yen has been bought since the LTRO announcement, and there's knee-jerk reactions or feasible explanation for why the yen to be bid like that? It's a great question, by the way, with GDP numbers in 7.5 minutes from now. Since the LTRO, the yen has, been under quite a bit of activity. Now, I would argue that the yen being acquired now, it's not so much of the yen that, here's I'll refresh a chart here. Look, you have the euro yen that enjoyed a tremendous move up. Let's erase all this stuff here. Okay? This is the euro yen. Now, yes, it has had a huge move up. But this is a result of the yen, the euro yen, in this case, being extremely, extremely oversold. But the yen crosses, if I'm understanding your question correctly, because the yen crosses have been very, very strong lately. It's a little difficult to maybe I'm misunderstanding your question as far as the time frame that we're looking at here. But the fact of the matter is the euro yen, the Aussie yen, the Kiwi yen have enjoyed enormous moves up. This is a daily chart going back to September of 2010 now. Because equity markets have been so strong. Let me refresh a chart here. Maybe it's just a chart. Nothing checked it correctly. You should see the whole thing now. Getting 2 questions here. Sorry. In terms of the euro yen and the other yen crosses, I think it's just a direct result of capital that continues to go into these equity markets. Don't ask me to explain this. I think it's irrational exuberance. Dow Jones Special Average is at 13,000. Are we, in terms of the Dow, are we in the same economy that we were in late 2007, early 2008 before things got bad? Now, granted, the fundamentals were really crumbling before the stock market actually crumbled. But nevertheless, there was a lot more banks, there was a lot more jobs that existed this time in 2008 than we do have now. So look, but the stock market, it's stimulus. And this bond purchase program is nothing more than more stimulus. I mean, if we're the CEO, if we're running a Fortune 500 company, and I have 0% interest rates, and I'm 0% that those interest rates are going to go up anytime soon, and we have an enormous amount of cash in the books, and we can't put this money into a savings account because we're going to lose money. We can't put it into bonds because bonds really don't pay anything anymore. What are we going to do? We're going to buy back stock. We're going to go out there and invest in new companies. We're going to pay dividends. We're going to do whatever we have to do to put this money to work. And that's why the stock market has been so strong, because cash has nowhere else to go unless you want to buy gold at $1,700 an ounce, which most people would say probably missed a big part of that move. Google, Facebook, significantly overvalued, much like the 2000 tech rubbish. I tend to agree with you. I think that things are very, very bubblicious at this point. 3.5 minutes ago, by the way, GDP numbers in the U.S. CDO's package and MBS was a time bomb. Yeah, I mean, look, if you look at the stock market in terms of a little bit more of an historical point of view, there's nothing new. There's nothing new in the stock market. Read about, and there's a lot of really interesting documentaries about the crash in 1929. You know the railroad companies. Now, the railroad companies, I know we're talking about GDP in 2012. I don't want to talk about something that's, 90 years, happened 90 years ago. But, you read about the very strong stock market in the 1920s. A lot of people draw parallels between, today's stock market and what we saw in the 20s. The high-flying stocks in the 1920s were the railroad stocks. In the 1940s, it was radio stocks like RCA. But the railroad stocks were like $200 a share back then. Now, what did the CEOs, what did those railroad companies do at the very, very top? 2.8%, by the way, is the GDP expectation. What did the railroad companies, which were the Googles and the Facebooks of the 1920s, they issued secondary offerings at the top of the market when their stocks were $200 a share. Why did they do that? To raise more money. Why did they pick the 1929 to do it when the stocks were $200 a share? Because those presidents knew that the market was very, very inflated. Hey, if I have a stock, if I own a company, it's $200 a share, I'm going to issue more and more stock as much as because I'm going to raise more money. And that there are studies have been done. They say when a company has a secondary offering after a huge move up in the stock market, it's the same thing. Is it illegal? It's not illegal at all. Companies can issue secondary offerings whenever they want. Is it unethical, immoral? Well, that's a judgment call. But same thing here. I mean, the Goldman Sachs and these other banks repackages the high risk loans. We call them subprime loans into CDOs and other financial instruments. But then again, and you could say, well, that's unethical. They were selling bad debt. They weren't selling bad debt. They were selling high yield debt. High yield debt in strong economies pays very, very well. If you owned subprime loans in those CDOs in 2006 and 2007, you would have made a lot of money. They did very well. But high risk, high reward. But high reward also means high risk. So when 2007 became 08, those very high reward investments like the CDOs became high risk. Well, they always were high risk. But we started to appreciate the risk component, not so much the reward component. So is it illegal? It's not illegal. Unethical, immoral, that's our own judgment call. But it's the same thing over and over again. That's why I don't like to buy into the hype. If everybody's very excited about something, then I tend to be skeptical. 8:29 a.m. Eastern, 1 minute ago, U.S. GDP expectation is, I'll give everyone there. Here's the calendar, 2.8. I pressed the wrong button here. Okay. Here's the calendar. 2.8%, I believe, is the expectation. 1.8% was a previous figure. That's annualized fourth quarter GDP. A number higher than expected. We would we would likely believe, I'm going to go with the dollar Swiss currency pair, by the way. If the number is better than expected, we would likely assume that this means less of a chance of quantitative easing 3, more of a chance of higher interest rates. Gold and oil is too expensive. When the VIX and equities are up, bonds 30-year, the 2 years hold the same day, euros up, silver is up, precious metals up. Still scratching my head wondering what the heck is happening when earnings are subpar to bad. You and I are watching the same markets, Mike. I agree with you. I'm watching all of my news feeds here, trying to get the first. U.S. GDP, fourth quarter preliminary GDP up 3% versus advanced GDP of 2.8%. That's higher than expected. Fourth quarter GDP consensus 2.7%. Preliminary real final sales at 1.1% versus expectations 0.8. Preliminary PCE price index of 1.2 versus advanced of 0.7. So far, everything is better than expected, and it keeps on going up. PEC price index of 1.3 versus the advance of 1.1. 1.1 versus 0.8 on the preliminary purchase price index. So far, every single indication reading is up, more than expected. Chain weighted price index of 0.9% versus the advanced figure of 0.4. Fourth quarter consumer spending of 2.1 versus advanced 2.0. More than expected. Better than expected. Where's the Dow? Dow Jones Industrial Average Futures, 13,029. Believe it or not. The more we go up, the more pessimistic I get. Where's my dollar Swiss C chart here? Here's dollar C. 5-minute chart. Let's look at the initial reaction. So far it's going up. Okay. Not easy for the fundamental bears like me out there. I mean, at the end of the day, look, we look for a trade based on a fundamental reason. I think the stock in Apple Computer will go up because they make great products and they have, what's the term? They have, they have a very, big market share, etc. So fundamentally, the stock looks good. Technically, I want to wait for a period of time that the chart agrees with me. Now, if the chart agrees with me at $535 a share, I'm not buying it for different reasons. I think that sort of experienced a very big move, but if I was a stock day trader still out there, I would still look to buy Apple Computer because it wants to go up. The fact of the matter is, we can look at the economy, we can say, I don't get this at all. I could go on for a 2-hour tangent about why I don't believe the economic numbers. But the fact of the matter is, you look at the Dow Jones Industrial Average. Look at this chart. By the way, well, I'll talk about something else in a second. Throw on, if we don't know which way the market's going, throw on a 20 simple moving average. Doesn't matter. Simple, exponential, doesn't matter. Here's the Dow Jones Industrial Average. 20 simple moving average, throw on another one, make that a longer one. We'll call this the 40. No reason. I'm just double checking. 40, we'll make this blue. The 20 is above the 40. This is an uptrend. Whoops, I'm sorry. Okay. White line is a 20 simple moving average. Blue line is a 40 simple moving average. This tells the whole story. This doesn't know about the fundamentals. This only knows that there's more buyers than sellers. And the market continues to go up. Look, if you want to be a conspiracy theorist about this and say fundamentally the economy is still very weak, we could look at any number. Take a look at the unemployment number in the U.S., 8.3%. Well, that's good. Better than 8.5, better than the 10.1 or whatever the peak was. But then a lot of economists will say, listen, the unemployment number is 8.3%. It doesn't really reflect what's going on. Because for all those people that have dropped out of the workforce, that are now able to take advantage of 99 weeks of consecutive unemployment insurance, they're not being counted in the workforce, so there's less people looking for jobs. Therefore, the unemployment rate will go down. You could look at the CPI. The CPI used to be known as the Consumer Price Index. It's now considered the cost of living index. Now, don't ask me to explain exactly what the difference is, but the fact of the matter is that it's being calculated in a somewhat different way. I heard an analyst talking about this on Bloomberg. I can't remember exactly the argument he made, something along the lines that, if we go to New York City and we go to Morton's Steakhouse and we buy a steak, it could be $100 steak. It's one of the best steakhouses in New York City. Or we could go to another restaurant, medium restaurant, and pay $30 for a steak. In the old days, CPI, it would measure the price of the steak at the same restaurant. Now the cost of living index compares different items from different restaurants, but the same price. So Morton's will charge us $100 for a steak. Another restaurant will charge us $30, but that price has gone down. That means there's no inflation. And that the Fed basically says, hey, you look at the last CPI number, it was up 0.2%. What's the CPI in the U.S. over the past year? Maybe 1%, 2%? You take a look at the price of gasoline in the U.S. for all of those of you in the U.S. Has gasoline only gone up 1% in the past year? I would argue a lot more. Look at the price of food in the supermarket. That's gone up a lot more than 1% or 2% in the past year. So we could always argue that maybe the government has their fingers in the numbers a little bit. Maybe the GDP number is not really 3%. But at the end of the day, none of this matters because the 20 simple moving average is above the 40 simple moving average, just as an example. And as long as this continues to be true, this means the stock market's still going up. Lottery tickets are now $2. I wonder if the payout is double as well. Maybe, I would guess that's taxes though. I don't think that, that's so much inflation. I would guess it's taxes. Seems like something they would tax. But then again, taxes also factors into inflation. In fact, taxes make things more expensive. The question, Harley, why is volume in the market down? That is the million-dollar question. And it's a very, very important question. I don't know necessarily why. Take a look. This is the Dow Jones Special Average chart. The volume has been at these lows since the beginning of the year. But if you go back, we can see going back to the volume spiked last August. That's nothing. And, a lot of people would argue. I always make this analogy. I'm sorry for repeating myself, but you make this analogy. We have elections coming up in the U.S. this year. If I ask 10 people I know, who are you going to vote for? Those out of my 10 friends, we're all kind of, on the same side of the fence. 8 of them are probably going to say, I'm going to vote for this guy. Does that mean that this guy is actually going to win the election? Not necessarily. I'm just taking a very small sample size. If I ask 300 million Americans who you're going to vote for, I think that answer will be a lot more representative of the actual likely winner of the next election. So the fact of the matter is the volume is down so much that the Dow Jones Special Average at 13,000, it's not as representative or it's not the right word, but it's not as indicative of where the economy really is. Besides the fact that it's not a broad-based rally. If you look at the companies in the U.S., look at the Dow Jones Special Average, that 13,000 represents the 30 largest companies. Not all the companies are doing equally well. You take a look at, and I know this is not in the Dow, but Apple Computer, $535 a share. Bank of America, $8 a share. That's not what I call a broad-based economic rally across the entire country. Is Apple doing as well, or I should say, is the banking sector doing as well as technology? Is the housing market doing as well as social networking? No, it's a very, very narrow economic rally. Think of the bubble in the year 2000. In 1998, 1999, it was a broad-based rally. Think of the last days of the bubble in 2000. What we're doing very well. Qualcomm, Redback, Pets.com. The banks, and I remember Ford at the time, it was only $28 a share or $25 a share. Meanwhile, Pets.com was $200 a share. Think of the market in the year 2007, 2008. The banking stocks and the home building stocks were very, very strong, but there was a lot, Sun Microsystems was still $4 a share. That's not what I could call a broad-based rally. At the end of big market moves, the strength will become very, very narrow at the top. Okay, I don't have a lot of time left, and I have a lot of comments here, so I don't want to continue to ramble on and on without answering these questions. Okay. Again, it just says, like a company who can perform accounting tricks, can the company look at a country can do tricks to report and also make it. Listen, I'm a conspiracy theorist, and I happen to agree with you. I think that they have their fingers in the stew a little bit. But, being a conspiracy theorist doesn't make money, doesn't make us money. At the end of the day, making us money, trading, is finding the trades that make the most sense. Hopefully, our fundamental view will agree with our technical view. That's in a ideal situation. Fundamentally, I've been bearish for a long time, but I have been day trading, and when I day trade, I usually am only buying because look, I could be as bearish as the next guy, but the euro yen, if it's going up, the Aussie yen, if it's going up, I'm not going to throw away good money just to, I've done that already. I've shorted strong stocks. It's not fun. If the market's going up, buy it. If it's going down, sell it. Hopefully your fundamental view will agree with that. But at the end of the day, we have to listen to what the market is actually doing. I'll remind you of a very well-known money manager of a hedge fund called Tiger Asset Management. And in 1999, and they were very, very successful in the late 90s, buying the tech stocks. They rode the tech stocks all the way up. In 1999, 2000, they started to short the tech market. They saw there was a bubble. They shorted tech stocks, but they shorted a little too early and a little too big, and they ended up blowing up and going out of business. Shorting tech stocks in the year 2000 or 1999, just a little bit too early before everything crashed. If they had waited a little bit longer, waited for the moving averages to cross over, waited for, the market to turn bearish, we would be talking about a completely different hedge fund right now. Imagine being able to short tech stock in the year 2000. So, same thing here. I don't know if this is the end or the Dow could go to 13,500 or 14,000. Who knows? But we can't ignore what we see here, which is a strong stock market. A strong stock market with a relatively low VIX and weak volume. But I am fundamentally, every single day I'm considering the contrarian argument. Lost my chart. Okay. Concerning, okay. Is it because no confidence in the U.S. economy or the euro debt problems? Well, it's a combination of both. I mean, consumer confidence, these reporting agencies have been reporting that consumer confidence is growing better than expected. But consumer confidence does play a very big role. Yesterday's consumer confidence is up. How is that gas price so high consumers can still shopping? Who knows? I don't know. I'm not shopping. I'm not buying anything new. Apple's coming out with a new iPad. I would love to get one, but I see, I'd like to believe I see what's happening out there. I don't think it's good. So, I'm not extending myself at this point. CNBC guests are claiming to buy. Well, thank goodness we're not following CNBC, right? I knew the bear was coming. I made good buys this month for this week, but I'm like that you mentioned. I shorted too soon. Right now, I'm taking which well. At the end of the day, if you're not doing something that's making money in the market, at the end of the day, our trading accounts will tell us if what we're doing is good or bad. If you're making money, stick with it, whatever your strategy is. If you're not making money, trade smaller or just stop trading altogether. Wait for our strategy to get realigned back within the market. And, we can make the analogy of that. We're sailing on the Atlantic Ocean. We're sailing from New York. We're sailing to London. Well, there's a good time and a bad time to sail. High tide, low tide, whether the wind is going from the east or the west, or I don't know. If what we're doing is not making money right now, whether it's shorting a strong market or, maybe we're, shorting at the wrong time or the stops are too close, the difficult thing is to figure out what it is that we're doing that's bad. But if whatever we're doing is not working, it's not making us money, stop doing that. Go back to basics. Say, okay, what am I? Listen, I go through the same thing all the time. Go back to a foreign exchange pair. I know I don't have a lot of time left. What's been a strong pair? Aussie yen. Daily charts. Okay? I take away all this entire mess. We say to ourselves, okay, throw in an indicator, moving average. This is the 40 simple moving average. Throw in another indicator, moving average. We'll make this 20, and we'll change the color to white. Beautiful. Okay. The 20 simple moving average is above the 40 simple moving average. Okay? It's very tempting to sell short because I sell short here and this is the top. Wow, look out. We could really go down. But selling shorts would have been the bad way to go. Would have been the wrong trade. Exactly which moving average you use, that will take a little bit more interpretation. Is the 4-hour charts. If we had looked to buy the Aussie yen every time the 20 was above the 40, the white line was above the blue line, we would have been buying this all the way up, and that would have made money, most likely. Our stops below the 40 moving average would probably almost always have not been stopped out. Whoops, I'm sorry, Mel. I'll refresh the chart here. Here's the chart again. There's a 4-hour chart Aussie yen. If you wanted to sell short the Aussie yen, well, this was the last signal to sell short, was if the 20 crossed below the 40. But we would have been stopped out, most likely. The trend is your friend. Whether we agree with it or don't, I do not agree with this trend. I'll go on the record. I think this is ridiculous. But this ridiculous market is what we have with us right now. So bears can either take a vacation or, at least for the short term, put our fundamental opinion on the side. I prefer to take a vacation, but we can't. So I'm gonna trade with what the market's giving us. To recap, U.S. GDP, all numbers better than expected. This would likely, I would expect to see stocks strong today, but be very aware if the stock market does not rally on good news. Last thing I'll say, be very aware of the fact that the market, when it starts to ignore good news, maybe the market is ignoring that good news for a reason. So watch the stock market today. If the stock market is up 100 points, I won't be surprised because the trend is your friend and this is great news. It should be up a lot today. If the stock market is up and then gives up the gains and starts to, turn back to the downside, I'm going to start to get very, very skeptical. More skeptical than I already am. Here's the Dow Jones Central Average. 13,000. We've been flirting with this level for a long time now. Well, going back to February 19th, a couple weeks now. If we have a reason to go up, this is the reason. Better than expected GDP numbers. This is a big boy. If the market ignores this good news today, and you'll see the same thing in the Euro Yen and the Aussie Yen, etc., then my skepticism will definitely increase. And of course, putting this together with the story we're talking about, the Euro Yen or the Euro currency. Here's the Euro Yen. The Euro Yen's negative for the day. I have a lot of reason to believe that the Euro will go down because of this bond issue. So if I'm bearish, I'm going to look to the Euro Yen. If I'm bullish, I might look to the Aussie Yen. Do I watch more of the Dow or the S&P? I watch both. Just by habit, I happen to watch the Dow Jones Special Average, but either or. Look, stock traders will look at the difference between the two, but I'm mostly focused in foreign exchange these past few years, so I watch, mostly the currencies, but I watch both, but not one or the other. Mostly the Dow, just because it happens to be on my screen. Unfortunately, I'm out of time. If you have any questions, you can contact me directly, www.com. We want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar. There's a lot more ahead of us. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back in time.